Unemployment, inflation, and war. Oh my, let's get into it. Hey guys, how you doing? Werenka here. I'm a state of Michigan broker for Simply Home. We're one of the fastest growing real estate companies in the United States, and I've got an all-star team. So whether you're looking to buy, sell, invest, rent, whatever you need, we've got you covered. We even do property management now. So this is a video topic that I haven't had to talk about in a great long while, but it's very prescient right now. So let's talk about it. We're entering a financial market that is in complete turmoil. Petroleum prices are spiking through the roof. Shipping in the Strait of Hormuz is shut down right now. There's war going on in the Middle East, and the financial markets are pretty flat except for like 7 AI companies, which are propping up the entire S&P. Traditional safe havens like treasury bills, gold, silver are all over the place. So what do we do to park our money and keep it as a safe investment that should keep a steady positive return going? Just so happens that I'm in real estate. Traditionally, when other financial markets get a little bit shaky, real estate is the safe haven where it's a smart place to put your money. So we're going to talk about that today. One of the good things about real estate in this type of market is that it's not liquid. It's a slow asset. You can't just panic sell it like you would a stock or a bond or anything else really. And that lack of liquidity is actually an asset in a volatile market because it prevents you from just panic dumping an asset that you have. And then let's take it a step further about where you should be investing because, investment properties are not the same all over the country depending where you're thinking about purchasing. And I'm going to make the argument that the Midwest and, Detroit specifically is one of the safer places to park your money right now if you're thinking about investing in real estate for various reasons that we'll get into in a minute. Because there's a big difference between speculating and investing. Like in certain parts of the country where the real estate market has gotten so inflated, it's so expensive, the barrier to entry is so high, you're basically speculating at that point. You're just betting that prices will continue to go up. I'm not sure that's a bet that I'd be willing to take at this point. And in our market, on other parts of the Midwest, other parts of the country, it's traditional, like truly investing in real estate. You're letting the cash flow work for you as opposed to just crossing your fingers and hoping that you see some kind of return down the road. I know a lot of my investor clients like to stick to the 1% rule. And that's just the rule saying if you can get 1% of your investment back every month, that's kind of the benchmark they're looking for on rental properties. And that math is broken in a lot of the coastal markets, South Florida, the Northwest, Southern California, Arizona, things like that, where the prices are so high that, that's an unrealistic goal because the rents aren't nearly high enough in those markets to recapture 1% of the purchase price every month. But that's absolutely 100% doable here in our market. When it all comes down to it, real wealth protection in this environment in our market, it's not about the gross yield. It's about net operating income preservation because it's not just about the price of the home. There's other things that you need to consider, such as homeowners insurance. I mean, it's Detroit, so our insurance rates are elevated in the city, but our market is not under extreme duress like it is in like South Florida. And furthermore, depending on where you want to invest in our market, our homes are generally really well constructed. We're talking in 1950s, 1960s build, maybe 1940s. They're, built by craftsmen. They're brick construction in a lot of cases. They're just really sturdy, well-built homes that, they obviously need, maintenance and upkeep over the years, but not to nearly to the extent that a lot of, cheaper, maybe less sturdy built homes need. And, when we want to back it out from, what's going on right now and take a look at the big picture, climate wise, we're in a really good spot here in the Midwest. Because let's just face the facts, like parts of Florida are on their way to becoming uninsurable. Same with parts of California. Cities like Phoenix, which, is near and dear to my heart. I lived there for 5 years. I went to Arizona State for college. Phoenix is running out of water, and that's going to be a massive problem moving forward. I've already had friends that moved out of the Phoenix area because of that reason. Well, at least that was one of the reasons. Obviously, when they turned their tap on and like a little cloud of dust didn't come out, they still got water, but they could look at the big picture and see that that potentially is not going to be the case in, however many years out. So that was one of their factors in moving. But the Detroit market, or Michigan in general, I mean, people are starting to call it a climate haven. I mean, think about it. We're pretty well insulated from natural disasters. We get the rare occasional tornado here and there, but we'll get an earthquake here and there, but it's like a 2 on the Richter scale that you can't even feel. We're at about 500 feet elevation, so we're not susceptible to, to our shoreline, getting swamped by the ocean. And we're located in a temperate climate that sees all 4 seasons. And most importantly of all, we're surrounded by 21% of the world's surface fresh water. That is becoming a massive deal in an era where water scarcity is starting to become a problem. So if you're looking at a longer term play here, maybe moving your capital to a place where the ground isn't literally underwater or on fire would be a smart move. That's a 50-year play and not a 5-year flip. And then let's talk about basic supply and demand economics. Michigan, we need about 25,000 new builds a year to really keep up with our demand, and we're only getting 9,000. So when you think about the high demand plus the low supply, that ensures that you're always going to have a steady supply of tenants to put in your home because they're going to need someplace to live. And I know that our region is, referred to as the Rust Belt, but we're so much more than that. We've got a new international bridge going in that's ready to open anytime now. You look at the Michigan Central train station in Corktown in Detroit, which sat empty and was an eyesore for 40 years. Ford Motor Company came in, renovated it. It is absolutely beautiful. The whole neighborhood around it has completely transformed. It's just the whole region is amazing now. We're one of the only, if not only, major city in the United States that has a maritime international border. So we're kind of a regional logistics hub as well. And, there's obviously the auto industry here, but we have so much more than that now. We're so much more diversified than we used to be. There's, the 2 biggest mortgage companies in the United States are both in Metro Detroit. We've got Google, we've got universities, we've got hospitals. There's so many opportunities now that there maybe weren't even like 15, 20 years ago. So there's definitely a lot going on here under the radar that you wouldn't think about. And then because our barrier to entry here is so low comparatively as far as acquisition price for real estate, in 2026, the Metro Detroit market is projected to see about a 9.5% increase in property values, which most of the rest of the country is not going to see. They're going to be in low single digits, if at all. And in some areas are projected to actually decline year over year. And we can even take it a step further and talk about the luxury market here, because the barrier to entry into the luxury market in Metro Detroit starts at, in about the low 700. Think about Miami or New York City or San Francisco. Like, that's not even going to get you a studio apartment. So you can build an entire portfolio of luxury investments here for the price of a single property in other parts of the country. And let's break that math down even more. So look, in the higher interest rate environment that we're in right now, the carrying cost of $1 million asset in like Austin, Texas, with a 3% vacancy rate is a total wealth killer. You're not going to run into that here. For example, in Detroit, because the entry point is so lower, the equity to cash flow ratio is superior. Just think of the debt service on a $200,000 asset versus a $1.2 million asset. As a savvy real estate investor, what you're doing in that instance is gaining liquidity and breathing room. And let's break out some real estate jargon just for fun and call it an asymmetric upside with a built-in floor. So the floor, think about this, the replacement costs on these houses that we're talking about, these sturdy, well-built brick homes that were custom made by craftsmen, to rebuild that same house to the exact same standard that it is right now, we're getting close to $350 a square foot. And you're purchasing them right now as is for $150 a square foot. So what you're really doing is buying the intrinsic value below the cost of the raw materials that it would take to rebuild that property. And the upside is you're doing that in an international logistics hub in a city that's got an international maritime border with another country. But obviously, great investment areas aren't all built the same. You can't just like buy one house in one part of Detroit, buy another house in another, and expect them to perform anywhere even remotely the same. Because the reality is, for all the great things that our region does have to offer, in the city of Detroit, one block could be a gold mine. The next block over is just not a gold mine. Let's put it that way. And that's why you need somebody to shepherd you through the areas that you really want. So from an investment standpoint, to my mind, the more important than somebody finding you the good deals that will cash flow is someone who knows the market enough to tell you which properties to walk away from, even if they look great on paper. Because at the end of the day, just like anything, there are built-in risks, and knowing the areas to avoid is mitigating a big risk when investing in the city of Detroit, or just the Metro Detroit area in general, or the Midwest in general, or just real estate in general. But all in all, I think the proof is in the pudding. I've got clients literally from all over the world that invest here because they've identified Detroit as a smart investment for all the reasons that we just talked about and more. And depending on your risk tolerance and what your investing strategy is, Metro Detroit and the city of Detroit in particular may or may not be a good fit for you. But we don't know that till we have that conversation. And that's a conversation that I'm always happy to have. So if you have any questions whatsoever, you can just always reach out directly. Call or text anytime. My direct line is 586-491-5622. You can reach me at Werenka@simplyhome.com. I'm on all the socials. Just DM me. I'll respond back quick. But I hope this video helped. I hope it was informative. Hope it informs your decision on the best use of your money. I think you could do a lot worse in our current investing environment than to give Metro Detroit a consideration. Regardless of what your strategy is, reach out anytime. Hopefully I can help you. Thank you so much for watching this, guys. Have a great one. Have a great rest of the month, and we'll talk soon.